The Gold Illusion. Why America Still Believes in a Shiny Rock. This is Frostline Economics. We follow incentives, not slogans. If we melted every ounce of gold humans have ever pulled from the earth and set the cube right here in Washington, D.C., you would not get a skyscraper. You would get a big, dense block that looks smaller than the myth that lives in our heads. That's lesson 1. Gold's power isn't sheer size. It's belief, coordination, and memory. Before we go anywhere, if deep, clean, no-fluff analysis is your thing, hit subscribe and tap like. It tells the algorithm that long-form thinking still matters. Now, let's figure out why a yellow metal from exploding stars still moves the most powerful economy on Earth. Start with physics, not poetry. Gold's electrons move so fast they bend color, absorbing blue and reflecting warm light our brains associate with the sun. It stays bright because it refuses to rust. It's dense, soft, and endlessly workable. It is rare, but not too rare. Those traits turned it into humanity's favorite canvas for meaning. Priests held it up to the light. Rulers wore it on their heads. Artisans hammered it into icons that outlived empires. And eventually, traders realized something bigger than art was hiding in plain sight. A metal that never decays is a ledger that never forgets. Money begins as usefulness. People traded cattle, grain, salt, things that fed bodies and warmed homes. Those are excellent for survival and terrible for long-distance exchange. You can't make change from a cow. You can't carry 3 sacks of barley over a mountain pass. So the human mind made a trade of its own. We swapped utility for standardization. Gold and silver won because they were portable, divisible, recognizable, and hard to fake. A stamp turned atoms into rules. A weight turned rules into trust. From there, the story accelerates. Empires found that gold isn't just wealth. It is movement. Spain melted sacred art from the Americas into uniform bars and coins, not because they hated myth, but because they needed rail-straight value for an empire that stretched across oceans. The British refined the idea further and built finance on top of it. The United States came late and then rewrote the ending. By the 19th century, the idea had matured. The metal was no longer just for crowns and chalices. Ordinary people chased it to riverbeds and frozen hillsides. California in '49, the Yukon in winter, South African reefs. Gold fever did not merely move markets. It moved families. It moved languages. It moved the map. And yet gold's most important move was still ahead. It would leave our pockets, disappear into vaults, and return as paper. Banks realized they could store metal and issue claims, the early banknotes, promises that said this paper equals that weight of gold in our basement. Convenience exploded. Fraud and panic did too. If everyone showed up for their metal at once, the system broke. The United States created a referee. In 1913, the Federal Reserve arrived with a simple pitch: centralize reserves, calm the panics, smooth the seasons. The gold peg stayed, but power shifted to a manager with levers: interest rates, liquidity, lender of last resort. Then reality tested the theory. The 20s roared. The 30s collapsed. With prices falling and jobs vanishing, the gold tether that had once provided discipline became a straitjacket. To save the patient, the doctor cut the strap. In 1933, the United States ended domestic convertibility. Money became fiat. Valuable because the republic behind it had both a printing press and the power to stabilize outcomes. Globally, the story ran one more lap. In 1944, at Bretton Woods, the United States told the free world to tie its currencies to the dollar and promised to redeem dollars for gold at 35 an ounce. For a generation, the promise held. Then deficits mounted, redemption lines formed, and in 1971, the gold window slammed shut. From that day on, the dollar has floated on trust. Trust in American law, in American productivity, in American military power, and in the self-interest of the world's savers who still see U.S. Treasury debt as the deepest, most liquid harbor in every storm. So why does gold rally again and again, in a world where the dollar reigns and markets are deeper than ever? Because the dollar is a story with referees. Gold is a story with no author. When faith in referees wobbles, people reach for a rule that lives outside of politics. When inflation flares, when Congress looks unserious, when policy feels improvised, when geopolitics heats the air, the private and official sectors do the same simple thing. They buy neutral reserve. They buy time. They buy gold. None of this makes gold holy. It makes it useful. And usefulness is never just atoms. It is incentives and probabilities. At Frostline, we refuse to romanticize rocks or demonize central banks. We map where the energy flows. Fiat money's superpower is elasticity. It can expand into crises, contract out of bubbles, and finance public goods at a scale no metallic system could. That same elasticity is also the weakness. It lives on human judgment and the politics that surround it. Get the judgment right and the system hums. Get it wrong, and trust gets discounted in the price of everything. Gold's superpower is independence. It is no one else's liability. No board meeting can dilute it. No sanction can erase it. That independence is also a weakness. It does not compound itself. It does not throw cash flow. It lives on price and belief and storage costs. Used as a measured hedge, it adds resilience. Worshipped as an answer to everything, it starves growth. Crypto borrowed gold's pitch and added software. Digital scarcity, self-custody, 24/7 global rails, bearer assets you can move with a seed phrase. It also imported a new set of risks. Code is only as strong as governance, and narratives move faster than due diligence. In calm seas, the rails win. In storms, some investors still prefer the rock. Here is the part people miss. The underwhelming cube on the mall is not a disappointment. It is a physical reminder that value is social, not geological. Dollars win when coordination is trusted. Gold wins when coordination needs to catch its breath. Crypto wins when users demand sovereignty and speed at the same time. Sensible allocators treat each as a different tool. They finance their future with productive assets. They protect their future with credible hedges. They refuse to let ideology turn any tool into a religion. If this view of the system resonates with you, subscribe to Frostline Economics and tap like. It helps serious work find serious people. Back to the story. Let's revisit the mental leaps and make them personal. The first leap, usefulness to metal, is the daily life leap. You exchange something you can eat for something you can store. That's the origin of retirement. The second leap, metal to paper, is the trust leap. You outsource storage to a specialist and accept a claim because the claim lets you move faster. That's the origin of banking. The third leap, paper backed by metal to paper backed by institutions, is the credibility leap. You accept that we can manage value not with a fixed rock but with a moving rule set. That is the origin of modern macroeconomics. None of these leaps are natural. All of them are learned, and every generation relearns them the hard way. America learned them in panic and depression. We learned that discipline without flexibility breaks. We also learned that flexibility without discipline spends the future too easily. That's why the best periods in U.S. monetary history feel boring. The rules are clear. The humility is visible. The Fed aims for stable prices and full employment and talks like an engineer, not a savior. Markets do most of the work. Politics sets goals. Policy executes them with steady hands. The country grows. The dollar strengthens. Gold rests. And then the cycle turns. Prices jump. Politics overheats. Congress fights the clock instead of the math. Central banks are asked to fix things they cannot fix. Investors do the thing they always do in those times. They diversify belief. They don't abandon dollars. They buy options on distrust. They reach for assets that do not depend on anyone's promise to keep their promise. Central banks outside the dollar bloc do a version of the same thing. They add gold because it is hard to sanction, easy to audit, and uncontroversial in parliaments. They may never need it. They feel better holding it. That's what a hedge is for. What about the environmental cost and the moral fog around mining? Those are not footnotes. They are part of the full price. Mining can scar landscapes and exploit weak institutions. Recycling helps. Stronger standards help. Transparency helps. But there is no free lunch. Every monetary technology has an externality. Fiat's externality is political temptation. Gold's is extraction and storage. Crypto's is energy and complexity. The honest conversation admits all three and then compares them at the margin for the job at hand. Let's talk personal finance, the part people pretend is separate from macro. It isn't. Your household runs a small version of the United States. You earn, you borrow, you invest, you insure. Productive assets are the engine. Reserves are the shock absorbers. In normal times, you barely think about the shock absorbers. In bad times, they are the only thing you think about. If you are young with rising human capital, your reserves might be tiny and your engine huge. If you are older and drawing down savings, the ratio flips. In both cases, your reserves should not be a single story. Cash covers near-term obligations. Treasuries add duration with liquidity. Gold adds outside money ballast. Crypto, sized appropriately, adds portability and permissionless exit in a world where capital controls can appear faster than press conferences. Now, zoom back out. Gold is not coming back as the operating system of the world economy. That isn't cynicism. That's math. The modern economy requires elastic money and deep credit to coordinate billions of daily decisions. But gold never needed to be the operating system to matter. It's the failsafe, the bookmark you keep when the plot gets weird, the asset that says nobody else gets a vote in this ounce. You can feel the culture shift. A generation that watched bailouts, wars, a pandemic, and rolling fiscal fights wants resilience that doesn't require permission. That desire will not end the dollar. It will diversify the ways people hold value. Some will hold more gold. Some will hold more code. Some will hold a little of both and sleep better. What should policymakers hear in that? Not an attack, a signal. When the public demands more fail-safe, it's a request for steadier rulemaking. Clear frameworks, predictable behavior, less drama, more humility. If you want the public to hold fewer hedges, make the core system boring again. The best central banking doesn't steal headlines. It steals volatility. That brings us back to the vault. Fort Knox still glows. The New York Fed still holds foreign bars resting on Manhattan bedrock. The point of those rooms is not mystique. It is auditability. When words wobble, bars reassure. When bars feel excessive, words are working. The wise republic keeps both in good order. We should also be honest about what gold cannot do. It cannot educate a child, repair a bridge, or cure a disease. Productive investment can. Use reserves to survive stress so you can keep investing through it. The goal is not to die rich in hedges. The goal is to live well in a system that remains worth trusting. Before we close, if this style of analysis helps you think straighter about money, subscribe to Frostline Economics and Tap-like. It tells the robots there's still an audience for human judgment. A final thought about belief, because that's where we started. People say money is a collective hallucination. That's wrong. Hallucinations break when you blink. Money is a collective discipline. It requires guardrails, habits, and consequences. Gold endures because it supplies consequences without asking permission. Fiat endures because it supplies flexibility with a promise of restraint. Crypto endures because it supplies exit when institutions forget why they were built. America's job is not to pick a single altar. It's to keep the core system credible enough that hedges are small, portable, and boring. The healthier the rules, the less we need the failsafe. The sicker the rules, the more the failsafe rules the conversation. The cube on the mall is not a monument to the past. It's a mirror. It reflects how well we are doing at telling the truth about value. This is Frostline Economics. We follow incentives, not slogans. If this helped you see the system more clearly, subscribe, tap like, and share it with someone who still thinks gold is magic, or fiat is evil, or crypto is destiny. None of them are. All of them are tools. The work is knowing which tool you need, why you need it, and when to put it down. stay curious, stay critical. We'll see you next time.